should I wait until the stock market crashes before I buy stocks? This is a very, very common question we get in our community as well as on YouTube. And I understand it completely. Based on where valuations are today, which I'll get to in a minute, I think there's a very high likelihood that we have a crash in the future. The question is when. But I've been saying this for a while, and we had the COVID crash. We had a bad 2022, but I wouldn't consider 2022 a crash. But valuations are so high that I think a crash will happen eventually. It cannot sustain forever. But should you not buy stocks or not buy ETFs because of this? Well, let's first get into where we are from a stock market valuation perspective. Every week I report the stock market to GDP ratio. We are 89.4% overpriced based on what Warren Buffett considers the most reliable metric of stock market valuations in history. When you go to the 10-year PE ratio, which just cares about earnings, no matter where it's earned, we're 95% overvalued. Those are huge numbers. So I can understand your fear saying, if it's so overvalued, shouldn't I just wait until then? Well, let's go look at the history in recent times. Look at this overvaluation. We have been overvalued since 2013. Since 2013, we've been overvalued. And what was the S&P back then? 1,500, 1,400. So even though they were overvalued, what happened to stock prices? Well, fundamentals got better. The economy got better. Earnings got better. And it lifted these prices up. This is the mistake I made in 2018 and 2019 by selling so much, thinking, come on, there's no way that 30 or 40% is going to stay forever. Besides 1999, we'd never experienced that kind of overvaluation. I'm like, come on, it's not going to happen. Then look what happened. Skyrocket. Absolute skyrocket. If you have a long-term horizon, there are going to be a lot of bad things that are going to happen to the economy, to the stock market in that time. In order to get big discounts, you have to see markets fall. Here is the S&P 500 historical prices, but guys, this is not a regular chart. This is what's called a logarithmic chart. Every line is doubling. So this upward trend is subdued. It should be way more exaggerated. And look what happened. Great Depression, Kennedy assassination, dot-com crash, great financial crisis, COVID. And in between all of these, we had terrorist attacks right here. We had presidential assassinations right here. We've had we had 18% interest rates here. Things are going to happen, and they're going to be bad things. That's what causes stocks overall to fall. There has to be that bad feeling and that bad story, right? But your job isn't to worry about those things. Your job is to sit there and say, if I believe America is going to be better years from now than today, you should look at stocks falling as an opportunity. Then you're sitting there saying, well, then Paul, I'm definitely going to wait. Well, hang on a second. Before you get there, here's what I would recommend. The emotional part of all this is the hard part. And it has been proven time and time again that loss is felt so much more than the emotion of a gain. So you're going to feel 50% loss a lot harder than you're going to experience the enjoyment of 100% gain. So I understand that's very, very important to everybody watching. It's very important to me. I like seeing my assets go up. I like seeing my net worth go up. It has been tough to see it not go up as much, but the benefits we have now are, we do have a very good benefit. We have 5.5% 90-day treasuries. That's a great opportunity to park cash at something and make a good risk-free return. The issue we had in years past was that risk-free return was zero. So you're probably sitting there saying, okay, so I should wait until stocks fall. Just hang on a second. There's more to this whole story than just that. If you are close to retirement versus 40 years from retirement, your outlook should be a lot different, right? If you're 5 or 10 years from retirement, you should already be considering yourself, can I withstand a big drop in stocks? Is the feeling I'm going to get from having a 20% increase going to overcome the feeling and the potential delay of retirement than if I lost 30 or 40%? That should factor in. If you're early in your retirement, like Dalton, our in-house analyst who's 25 years old, he's got 40 years till he retires. He should not even think about where stocks are going to go in the next 5 or 10 years. All he should do is figure out the plan to get to retirement. This is exactly why we have our retirement calculator here, because it factors in your long-term as well as how much income you make today and what age you expect to live to. We consider this to be so important to sit there and stay on a plan. If you have the right plan in place, you make the decisions based on your plan. And be conservative when you do your annualized returns. Don't assume the last 5 years are going to happen for the long run, because they aren't. The market does 9 to 10% a year with dividends over long periods of time. That's probably the return you should expect. Keep in mind this. If you go to the S&P from the dot-com crash to today, the returns are about 6.5 to 7% with dividends. That's not a ton. Why? Because we had such overvaluation back then. And we have such overvaluation today that you'd sit there and wonder, what would the return be if it wasn't for this overvaluation? Probably be 3 to 4% with dividends, which ain't good. I just read today by John Hussman from 1928 to 2013, a period of 85 years. The risk-free treasury rate, T-bills, beat the S&P for 50 of those 84 years. But the other 34 years where the gains happened, they far surpassed that and made it well worthwhile to invest in stocks. The issue is you don't know which year we're going to be in. And that's why the rule is this that I'm going to tell you. If you're along a plan, continue to dollar cost average into low cost ETFs. Do it month in, month out, whatever method you do it in an IRA, 401k, stick to that plan. You should not care where stocks are going to go. If you have a portion of your money in buying individual stocks, just be aware that stocks can fall precipitously. And be all the more cautious when you're buying stocks. Put a little bit more margin of safety in there. Have your outlook 5 to 10 years out. It is hard to buy a stock and see it fall. But if you're an opportunistic buyer, you should use as an opportunity to buy more of that stock. If you still see the fundamentals getting better, but the stock price falling, I would ask you, then why are you worried about the stock price? Use it as an opportunity to buy more. But the number one most important thing is stick to your plan for retirement. Extra money, if you want to wait, you can park that in 5.5% treasuries, 5.4% treasuries, and get a decent return. But your IRA, your 401k, your retirement plan, do not deviate. Buy month in and month out. Who would have thought last year, 2023, would have happened? I didn't think so. 2023 was an insane year for the market. 20-some% return in dividend, including dividends. That is crazy. And that's what happens. You don't want to miss out on those. Just stick to your plan of low cost, dollar cost averaging into these low cost ETFs. You will do phenomenal. If you're close to retirement, be more cautious. If you have a lot of individual stocks, make sure your stocks have great balance sheets and you paid reasonable prices for them going up. Mo, for example, owns Apple. His basis is $17 a share. It's at $190 or whatever. He's got a great basis. And he said to me recently, should I sell it? It's so overvalued. Well, Mo, if you sold it, what are your tax? Oh, about $65 a share. Great. So would you own it for $125 a share? Well, yeah, I would. Well, then don't sell it because that's the same thing then. So just stick with it and realize you're either going to pay it in tax or you're going to pay it in a market loss. One of the two ways you're going to pay it. I'd rather pay it in a market loss and just hold on to it because you never know. If the market goes even crazier for even further, and the fundamentals get better, maybe your valuation goes even higher and your down market is a much higher level than paying the tax. And that's what's key here. But remember, guys, at the end of the day, what matters most is how do you sleep at night? If you're really going to toss and turn, then you have to reevaluate what investments you have. If the idea of one stock going down 50% is going to ruin your night, don't do it. Stick to the low-cost ETFs, put more in there. But at the end of the day, what matters most is stick to your plan. Don't try to time the market going in and going out. I have real estate, I have businesses, I have a lot of things going on. I can afford to time the markets to make specific plays that don't work out. I can afford that. If you're staying for retirement and all you have is your job in retirement, that's awesome, but stick to the plan. Trust me when I say you'll wake up years from now because what's going to happen is this. This is the long-term stock value and stocks are going to go like this, right? You're going to be regretting buying up here. You're going to be loving buying down here, but we never know where we are. Yeah, we could be here, but over here, if it just goes like this for longer, isn't as bad. And before you know it, you're undervalued. That's the point I'm trying to make here. Stick to the plan, low-cost ETFs, any extra individual money you have in stocks. If you want to stick that in cash and just wait for a bigger pullback, awesome. But if you want to buy individual stocks, just put a little bit more margin of safety in there for you. So if you want to see what individual stocks I am buying, watch this next video, 30 stocks I want to own forever. Thank you very much for your time.